There's a question I think all of us, whether seasoned investors or complete beginners, have asked ourselves at least once. Why does the market do things no one can explain? Why does a company that's performing well suddenly lose half its value in just a few weeks? Why can real estate prices climb for years only to collapse in a matter of months? Why do the smartest, best-trained investors, armed with the most advanced tools, still get blindsided by the market again and again? If you've ever asked those questions, then what we're about to explore together today may be exactly what you've been searching for. October 2009, the global financial crisis had just passed through its darkest phase. Lehman Brothers had collapsed more than a year earlier. Millions had lost their jobs. Trillions of dollars in wealth had evaporated. And the world was still struggling to understand what just happened, who was responsible, and more importantly, how do we make sure it never happens again? It was in this context that George Soros stepped onto the stage at Central European University in Budapest, a school he himself had founded in 1991, and delivered a series of 5 special lectures on economics, reflexivity, and the open society. These lectures didn't stay in Budapest. They were broadcast live to major universities around the world, including MIT, Columbia, and the London School of Economics, so students and scholars everywhere could follow along and ask questions in real time. And later, the entire series was published publicly through the Financial Times. This was not a typical speech. It wasn't a motivational talk, it wasn't a book launch. It wasn't a billionaire showing off his achievements. It was 5 serious academic lectures where one of the most legendary investors in history sat down and tried, systematically and honestly, to explain how he truly sees financial markets and the world. And what made these lectures remarkable wasn't the name of the man on stage. It was the courage of the ideas he shared. George Soros didn't come to Budapest to teach us how to pick stocks. He didn't hand out investment tips. He didn't share secrets to getting rich. He didn't retell his famous trades to impress the audience. Instead, he did something very few in finance dare to do. He directly challenged the entire theoretical foundation the world uses to understand markets. He argued that modern economics' description of financial markets, built on the efficient market hypothesis, on rational actors, on the belief that markets always self-correct back to equilibrium, was inadequate. In fact, he claimed those flawed theories had helped create and worsen the 2008 crisis. In their place, he offered a completely different lens, built on 2 central concepts he had developed over more than 40 years of research and real-world trading: fallibility. Human beings cannot understand the world perfectly. We always act on incomplete perceptions. And those errors in perception aren't exceptions, they're the rule. Reflexivity. Our perception of reality doesn't just reflect reality, it feeds back into it and changes it. Markets aren't passive mirrors. They are living feedback loops where human thought and action constantly generate consequences no one foresaw. When understood correctly, these 2 concepts transform how we see everything from how bubbles form, to how crises unfold, to why most investors underperform the market over the long run. So what is this video? It's not a simple translation or summary of those lectures. It's what I've learned from Soros's theory presented in the most accessible way possible, combined with real-world market examples so we can grasp not just the theory, but how to apply it in practice. Because understanding theory is one thing. Knowing how to use it to make better decisions in the real world, that's where the true value lies. We'll go through 11 parts, from the philosophical foundations, to the mechanics of reflexivity, to the anatomy of bubbles, to the super bubble of 2008, and finally to the practical lessons we can apply today. It will be a long journey. But I believe that by the end, the way we see markets and the way we make investment decisions will never be the same again. Let's begin. Part 1. Financial Markets, a Special Laboratory. In the opening of his lecture, George Soros does not begin right away by explaining the most difficult concepts about human behavior and economic laws. Instead, he starts by affirming the special position of financial markets in the study of those factors. According to him, if we want to correctly understand the ideas of human fallibility, reflexivity, and uncertainty, there is no environment more suitable than the financial market. Soros's financial market can be compared to a living laboratory. However, This is not the kind of laboratory that natural scientists use to conduct experiments with controlled variables. On the contrary, it is a complex and flexible system, constantly changing and impossible to control. On the other hand, in the financial market, every change is recorded fully, continuously, and in the most detailed way. The only tool to record those changes is data, all the information about market fluctuations. Any stock transaction, any movement in interest rates or exchange rates, every factor is recorded in numerical form. Based on this data, what can we do? First of all, we can reconstruct the past, review market history, and evaluate the events that happened before. We can look back at the past of the U.S. stock market and see how the market reacted to the shock of 2008. At the same time, we can follow the development of Apple, Amazon, or Tesla over many years. Thanks to the ability to collect information about the past and its flexibility, the financial market becomes perfect for testing hypotheses about human behavior. In the market, we can directly observe stock price fluctuations, the effects of corporate information, without having to conduct experiments in a psychology lab. However, the important point in assessing the financial market does not lie only in the ease of data collection. He emphasizes its special nature, a kind of direct reflection of human beliefs, expectations, and behavior. A clear example of this is the close relationship between stock prices and news about a company. When there is positive information, such as the launch of a new product, the stock rises. Conversely, negative information causes the stock to fall. However, the market never reacts completely accurately and rationally to news. There are situations where the market's reaction goes beyond what should happen. Good news drives prices up more than reality justifies, and bad news, on the contrary, drives prices down sharply. This shows that the financial market not only reflects information, but is also influenced by market psychology. A typical example of this is the cryptocurrency market. Many times, Bitcoin and other coins have risen sharply not thanks to value or technological success, but because of investor expectations. Optimism makes people buy more, and the price rises. Conversely, if they believe the market will fall, people sell en masse and the price also falls. With these examples, he affirms that reality and perception in the financial market are not separated. They constantly interact and change each other. According to George Soros, the special point he wants to emphasize here is the complexity of the financial market, where it interacts inseparably with human psychology. If in natural science the existence of a phenomenon does not depend on the observer, then in the case of the financial market it is the opposite. Perception changes the phenomenon itself. For example, if people believe that a bank is in trouble, they may withdraw money en masse, causing the bank to actually face difficulties. That is the interaction between perception and reality. Another important point he wants to emphasize is that the financial market can be observed much more easily than many other fields. For instance, social life has many complex factors such as culture, psychology, human relationships, things that cannot be precisely quantified. But in the market, everything is quantified through price. Stock prices, exchange rates, interest rates, every factor in the market can be collected and evaluated. With quantification, we can easily assess changes and make comparisons. Thanks to that, we can easily grasp trends, seeing stock prices rise from $10 to $100 over several years and fall from $100 to $20 during a crisis. But Soros emphasizes an important point. The complexity of the market lies in the fact that we have too much data about it. Therefore, many people mistakenly believe they can fully understand the market and even accurately predict its trends. Precisely because there is so much data, many people create mathematical models, trying to predict the market as if it were a physical system. But according to George Soros, that is a completely wrong idea. The market cannot be understood and modeled like a physical system with unchanging laws. The market is a system in which participants are both observers and agents who change the system itself. This leads to an important conclusion. The market cannot be understood and simulated as a physical system with fixed laws. To understand it, we need a completely different approach acknowledging human fallibility, limited knowledge, uncertainty, and reflexivity. First of all, we need to understand an important point. Humans cannot have perfect knowledge of the world. We make decisions based on incomplete, limited information. And those decisions change the market powerfully. An example of this is the phenomenon of FOMO, the fear of missing out. When the price of an asset rises, many people feel they will miss the opportunity if they do not enter the market immediately. They do not understand the true value of the asset, but only fear being left behind. The actions of buyers make the asset price rise even more. Conversely, when the market falls sharply, buyers fear losses and sell off, causing prices to continue to fall. Because the financial market reflects human behavior, it therefore carries psychological characteristics. Part 2. Challenging the efficient market hypothesis. After arguing that financial markets can be considered a kind of laboratory for studying human behavior, George Soros continues with another important part of his lecture, challenging the efficient market hypothesis, the foundation of modern financial economics. The efficient market hypothesis has long been treated as a truth in academic circles. This theory asserts that the prices of financial assets such as stocks, bonds, or derivatives always perfectly reflect all available information. This means that any information from financial reports, economic conditions, or investor expectations has already been absorbed into the price. The implications of this assumption are significant. If the market perfectly reflects all available information, then no one can consistently beat the market over time. All analysis, forecasting, or attempts to pick good stocks become meaningless, because all necessary information is already known and reflected in prices. In addition, EMH claims that markets always tend toward equilibrium. If there is a discrepancy between price and intrinsic value, that discrepancy is only temporary and will soon be corrected. All price fluctuations occur only because of external shocks, unexpected information that cannot be predicted, and therefore are random. Indeed, this theory looks very convincing. It creates the impression that financial markets are rational systems that can be described with mathematical models. Certainly, has served as the foundation for many other financial models such as asset pricing or risk management. However, according to Soros, this theory has a fundamental flaw. It assumes that humans always act rationally and can process information perfectly. In reality, this is rarely true. People are not logical machines. They are influenced by emotions, biases, and cognitive limitations. They can misunderstand information, overreact or underreact to it, and most importantly, they often act based on predictions about the future that are inherently uncertain. Soros argues that if the theoretical foundation is wrong, everything built upon it becomes questionable. He makes a blunt point. If EMH is correct, then his theory of reflexivity must be wrong, and vice versa. EMH claims that markets passively reflect reality. But Soros believes that the relationship between market prices and reality is not one way. Market prices not only reflect reality but can also feed back and change reality itself. This is a fundamental difference. To understand more clearly, let's look at an example from the stock market. According to EMH, when a company announces results that exceed expectations, its stock price rises to reflect this new information. The market price then stabilizes at the new appropriate level. In reality, things are much more complicated. When the stock price rises, the company can take advantage of this by raising capital more easily through issuing new shares. With this capital, the company can expand operations and improve its actual business results in the future. Here, the initial stock price increase not only reflects expectations about the future, but also participates in making those expectations come true. EMH does not account for this. More specifically, take the real estate market. When housing prices rise, banks may feel safer lending because collateral is worth more. This creates expanded credit, allowing more people to buy homes. Increased demand drives housing prices even higher. Here, market prices do not just reflect supply and demand. They directly influence supply and demand through the credit mechanism. This is a feedback loop EMH cannot fully explain. Soros also shows that in many cases, markets do not tend to return to equilibrium as the theory predicts. In fact, they can move further and further away from equilibrium, especially when positive feedback mechanisms are involved. A classic example of this is financial bubbles. If EMH were correct, bubbles could not exist or would be very short-lived. Reality is very different. Bubbles can last for years at massive scale before bursting. Take the dot-com bubble of the late 1990s. As digital technology began to spread, tech companies had extremely high valuations but no profits. If EMH were correct, the market should have corrected immediately when it saw the gap between price and intrinsic value. In reality, the market sustained those prices for a long time, even when they were many times higher than true value. Clearly, the market did not reflect reality as EMH claims. The expectation that technology would change everything was what drove prices up. Only when that belief was shaken did the bubble burst and prices collapsed. A more recent example is the cryptocurrency market. At times, the prices of many coins skyrocketed not because of real utility value, but because of the expectation that prices would keep rising. Buyers purchased coins not because they understood the technology, but because they believed someone else would buy at a higher price. This is speculative behavior, and it shows that markets cannot operate in the way EMH describes. Soros does not deny that markets can be efficient in many cases, especially under stable conditions. However, that is not the whole story. Markets may tend toward equilibrium at certain times, and at other times become severely imbalanced. It is this shift from near equilibrium to far from equilibrium that is truly worth paying attention to. In addition, EMH assumes that market fluctuations come from external shocks, but Soros insists that many major fluctuations do not originate externally, but are generated internally by the financial market itself. The lack of information and understanding among many participants can create strong boom and bust cycles. The evidence is that financial markets not only reflect reality, they also generate their own fluctuations. In summary, in this part of the lecture, Soros does not merely criticize a theory. He raises doubts about the very way we understand financial markets. Part 3. 2 core principles of financial markets. After pointing out the limits of the efficient market hypothesis, George Soros continues to build his theory of reflexivity by introducing 2 core principles. It is very important to understand these 2 principles because they not only explain how markets operate, but also form the foundation of his entire thinking. At first glance, these principles may seem simple, but the more you think about them, the more you realize they almost turn upside down the way we are used to understanding markets. Principle 1. Market prices are always distorted compared to real value. In traditional economic theory, price is seen as correctly reflecting intrinsic value. If there is distortion, it is only temporary and will quickly return to a reasonable level. But Soros argues that this is not true in real life. Distortion is not the exception, it is the normal state. Imagine a company with a real value of 100 in textbooks. The stock price will hover around 100, but in reality, it can be pushed up to 150 or 200 when the market is excited, or fall to 50 to 70 when people panic. This shows that price reflects not only value, but also psychology. A clear example is Tesla. At certain times, its stock price rose far beyond what many experts considered reasonable if you only looked at revenue and profit. But at that time, the market was not buying the present, they were buying expectations about the future. Conversely, during the 2008 crisis, many good companies were sold off. Not because the businesses suddenly became bad, but because widespread fear took over. The lesson here is very practical. Do not assume that price equals value. Price often reflects short-term emotions more than long-term value. Principle 2. The market not only reflects reality, it also creates reality. This is the point that makes Soros completely different. In the usual understanding, a business operates, produces results, and the market reflects through price. But Soros partly reverses this. Price can also feed back and affect the business. A clear example in stocks shows that when a stock rises sharply, the company can easily issue more shares to raise capital. With money, they expand operations, invest, and hire people. These things help the company actually grow. In other words, a rising price creates conditions that make the business truly better. Conversely, when a stock price drops sharply, it becomes harder to raise capital. The company is forced to cut back, and the business becomes weaker. Another example is real estate. When housing prices rise, banks see collateral as safer. They lend more people buy houses, prices rise further. This is a loop. Price does not just reflect the market, it pushes the market further. But when the trend reverses, everything flips. Prices fall, banks tighten credit, fewer buyers enter the market. Prices fall further. From these two principles, you can draw a completely different perspective. The market is not a scale that always balances. It is more like a pendulum, and sometimes it swings too far. Practical applications are clear. When you see prices rising sharply, do not rush to think it must be right. When you see prices falling deeply, do not rush to think it must be wrong. Always ask, is this real value or just psychology being amplified? A deeper lesson is that mistakes in the market are not just mistakes. They can amplify themselves into major trends. For example, if many people believe AI will explode, they pour money into AI stocks. Companies then get capital, grow faster, and the belief becomes truer over time. But the problem is that this process cannot last forever. When expectations exceed reality, the market will adjust, and often painfully. In summary, these two principles lead to a very practical perspective. The market is always distorted. And those distortions can change the real world. Understanding this, you will no longer see the market as a logical machine, but as a living system, where psychology, belief, and action continuously interact and amplify each other. Part 4. Reflexivity, the heart of financial markets. After stating the two important principles, that prices are always distorted and that markets can feed back into reality, George Soros takes a decisive step, explaining the mechanism that links these two principles. That mechanism is reflexivity. This is not a supporting concept. It is the heart of Soros's view of the market. Without understanding reflexivity, you cannot understand why bubbles form, why distortions persist, and why crises always arrive suddenly and devastatingly. Normally, we think in one direction. Reality leads to human perception of it, understanding it, and then acting. But Soros says financial markets are completely different. People form perceptions, whether right or wrong, and then act on those perceptions by buying or selling assets. These actions feed back into reality, changing prices and the economic conditions of the market. This new reality then feeds back into perception, altering people's beliefs. The key point is that initial perception does not need to be accurate to create actual reality. In the stock market, many investors may believe that an AI technology company has strong growth potential in the future. Even if this is uncertain, investors still decide to buy shares. Buying more means the price rises. Rising prices help the company raise more capital, which allows it to expand, hire employees, and invest in new projects. As a result, the company grows stronger, and the initial perception becomes more accurate. The reflexive loop continues. Or take the real estate market. When there is an upward trend in housing prices, many people decide to buy for investment. This price increase makes banks more confident in the trend and more willing to lend, thereby expanding credit. As a result, demand for real estate rises and prices continue to climb. At this stage, everything looks good and positive. However, the system is imbalanced because it rests on the assumption that prices will always keep rising. When this belief weakens, reversal begins. Fewer buyers enter, prices start to fall, banks tighten credit out of fear of losses, and prices fall further. Thus, reflexivity not only amplifies upward trends but also amplifies downward trends. Unlike traditional economics, where distortions are considered temporary, Soros argues that distortions can persist and even expand. This is because prices do not just reflect information, they also create information. If prices rise, we feel attraction and keep buying. If they fall, they create a sense of danger and push us to sell. The consequence is that markets can move far away from their true value. In phases dominated by positive feedback, bubbles form. In reversal phases, markets can collapse quickly and violently. However, markets are not always out of control. Sometimes, negative feedback phases occur that help stabilize the system. But the problem is that it is very difficult to determine which phase is dominant at any given time. In practice, what matters is not only looking at value but also understanding the story the market believes and whether that story is being amplified through the market itself. The market is not a static system, but an environment where human beliefs can transform reality itself. And that's where we'll stop for today. We've just gone through the first 4 parts of George Soros' lecture series, and if you've listened this far, I believe you're seeing the market differently than when we started. Let's quickly recap what we've covered. In part 1, we understood why financial markets are a living laboratory, not because they're perfect, but because they directly reflect how people think, feel, and act. In part 2, we saw him challenge the efficient market hypothesis, the theory the entire financial world leans on, and why he believes it's not enough to explain reality. In part 3, we explored 2 core principles. Market prices are always distorted, and markets don't just reflect reality, they actually create reality. And in part 4, which I consider the most important so far, we got to the heart of the entire theory, reflexivity, the two-way loop between perception and reality. The mechanism that explains why bubbles form, why they last, and why when they collapse, nobody is prepared. But this is only the first half of the journey. In the upcoming parts, we'll dive into things I think are even more fascinating. We'll break down the specific structure of a financial bubble, how it forms, the stages it goes through, and why even the smartest people don't recognize it until it's too late. We'll revisit the 2008 crisis from his perspective, and why he called it a super bubble instead of just another financial crash. And more importantly, we'll talk about what all of this means for us in practice, not just theory, but how to apply what we've learned to see the market differently and make better decisions. So, if you don't want to miss the next parts, like and share this podcast right now if you found it useful. There are others asking the same questions about the market as you are. Comment below and let me know. Out of these 4 parts, what made you think the most? Is there a section you'd like me to go deeper into? I read every comment and I genuinely want to hear your thoughts. And most importantly, subscribe to the channel and turn on notifications, because the next episodes will be posted soon, and without notifications, you might miss them. One last thing before we wrap up. I think what makes George Soros' lectures stand out from most of what we're taught about finance is honesty. He doesn't tell us the market can be predicted. He doesn't promise a perfect formula. Instead, he says something much harder to accept, that uncertainty is an unavoidable part of the system, that mistakes are the rule, not the exception, and that the truly wise investor isn't the one who never makes mistakes, but the one who knows how to face them and adjust. That's a lesson I think all of us need, whether you're investing or not. See you in part 5.